Quick live stream here. It's Mitch coming to you from Melville. Welcome to the live. Be the boss of your money. So here's what we're looking at. We're looking at a pretty negative pull over the market and over economic expectations. It's got I have to say the environment for this is mostly on, I would think, psychology, but let me explain. The environment for investors outlook for both the stock market and the economy has been deteriorating since roughly mid-July. There was no respite since Labor Day. We're looking at October already very soon. So we are definitely into fall, and actually today's the 21st, but I think this year the autumnal equinox is the 23rd, but I digress. We have consumer confidence deteriorating for about 11 to 12 months in a row, but we are not going by what consumers say about the confidence. We're going by how they spend, but the spending is slowing. Inflation continues to run hotter than expected at this point in the interest rate hiking cycle. And it's very clear to me anyway, and it should be clear, I think, to everybody that there's not a whole hell of a lot that the Federal Reserve could do for oil prices and droughts and high food prices. The Fed just can't really do much about it. Now, if there are things that are up in price, like discretionary items, the Fed could certainly, with its interest rate hikes, could certainly take a toll on the economy. But by and large, the Fed does not seem like the Fed's interest rate policy today is working the way it used to work. And because of that, investors are confused. The linchpin holding everything together is employment. And the employment picture for the United States anyway, it's still pretty good. It's even with some downward revisions in the last few months to previous employment reports, the revisions are nothing terrible. So as long as jobs continue to be around, I mean, it's hard to really envision a recession. What comes first? Fewer hours per week worked, a slower pace of wage increases. Those typically do come first, by the way, before we start to see labor get weak. In other words, you start to see a drop in temporary unemployment. You start to see a drop in the amount of weekly hours worked. And then you start to see a market slowdown in the pace of salaries rising. I think we are seeing these. So the other worry is that we're going into a recession in the next year. Now, we've been hearing this for a long time. We're going into a recession in the next 6 to 12 months. We always go into recessions. And if we don't go into a recession in the next 6 to 12 months, it would be unusual if we didn't, just because of the amount of time we have not been in a recession. It's pretty long. So the government has passed some new policies, the CHIPS Act, the Infrastructure Act. There's a ton of manufacturing going on, semiconductor chip equipment being built, plants being built. It's really hard to see a severe deterioration in labor. We need more labor in home construction than ever, and yet we have fewer people in home construction because so many people left the sector in the last recession of 07, 08, that we just don't have enough people to build all the houses that we need. So strong job demand over there as well. So having said that, we had an acquisition today. Cisco acquired a company called Splunk, technology company, for $28 billion. Stock is up in trading. So there are still deals to be had. There's still money to be had. There are still opportunities to be found. So we mustn't get overly negative. By the way, I know this sounds crazy, but I still have to run that introduction. So let me just run this real quick. This has been a pretty long week for the street. Let me run this and we'll be right back. All right, so it seems to me that we're in a stock market with very few places to go. Interest rates continue to go to the highest level since 2007. We talked about the 10-year yield going up because the 7-year and the 20-year were higher than the 10-year. So it's just a matter of time till the 10-year goes up. The way the math that's how the math works. And now we are going to be talking about 5% on a 10-year treasury. But the thing is, if interest rates are going up because of inflation, yet we're talking about a recession possibly in the next 6 to 12 months. And these two scenarios don't really jive together. If we're going into a recession, interest rates should be going down a lot. So this is a really tough market to figure out over the near term. Now, you know how we work here. We're in the long term, we're in this for the time, for the for the long haul. And we've got many more things to get through. So the things that we talk about mostly here are health savings accounts. When you use them for retirement, they could be an incredible retirement savings vehicle. We talk about the basics of insurance. We talk about the key basics: an emergency fund, spending less money than you make after taxes, doing things you could to legitimately lower your taxes. I'm not a tax advisor. Talk to your CP, your tax advisor, and you have a specific tax question. We talk about Social Security planning. None of these things change regardless of what the market is doing right now. But it is a tough market. A lot of people are optimistic. I just saw one top Wall Street strategist raise her price target for stocks in the year, and I've been pretty optimistic about the stock market. But my enthusiasm is waning, and I think I'm going to have to maybe put new all-time highs in the stock market into the 2024 column. It's getting a little bit late to really think that we're going to have any big fireworks before the end of this year, especially the year is just starting to wind down really quickly. The VIX was up. We talk about that a lot. It's about 17 and a half, was up 15% today. So there is a lot of worry creeping into the market. Consumers appear to be weakening. Stimulus money, extra cash that consumers had, rather, it's pretty much gone. China, which has been a consistent growth driver for global GDP, is not only knocked out of the box right now, but probably knocked out of the box permanently. So a lot of the things that we were used to relying on for the last 15 years have by and large disappeared. And in the meantime, the Fed has to get bonds off its balance sheet, which is called quantitative tightening, as well as maybe 1 or 2 more rate hikes. Now, we say maybe, I like to say maybe 1 or 2 more rate hikes. If inflation stays strong, the Fed's going to keep going with rate hikes. It's just that the things that are going up in price are not the things that are really impacted by rate hikes. If Saudi Arabia and Russia, if they pump less oil, so the price of oil in the global market goes up, how does the Fed affect what Russia does with the price of oil? How does the Fed affect the price of soybean or wheat because there's droughts or weather events all over the world? So that is the problem. The Fed is not really controlling the prices that it needs to control, but then again, it can't. And that's why this is so confounding. All the Fed is doing is just making life more expensive, more miserable. But I don't think it's really helping the situation with inflation. All right, that's my story, my rant. I'll be back Monday. So I hope you guys have a good night. And we have a lot more to talk about next week. But I just wanted to talk to you about this broad overview picture of what the market is looking at and why things are so rocky. And it seems like they could get rockier pretty quickly, given that the VIX was up about 15, 16% today. All right, that's my story. I got to go. Thanks.